You don't have what I call founderitis, which is like arthritis of the founders, that they say my way or highway. I know how this works. This is the way it is. You and I, neither one of us know how it works. The market knows because we don't have the decision to buy. They have the decision to buy.
Hi, and welcome back to another episode of Angels, Exits, and Acquisitions. My name is Jeff Barnes, and I'll be your host today. Today, I have the pleasure of interviewing Sid Mohasseb, who is a serial entrepreneur, an angel investor. He's had several exits. He's done some incredible things throughout his career. And we had a great conversation about the grittiness of being an entrepreneur and what it takes to be successful as an entrepreneur. And then what do you look for as that investor when you are looking at potential deals and potential investments? And how do you go through and filter those so that you can do this? Sid's looked at several thousand deals per year. So I'd say he has a really good knack for finding the right deals. He's done a great job of helping his portfolio scale and make a lot of money doing it. So look forward to hearing your comments and thoughts on this episode. And as always, like, subscribe, and share. Thanks.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. My name is Jeff Barnes. I'm the CEO of Angel Investors Network. And today I have Sid Mohasseb here with me. Sid, how are you?
I am excellent. And
wonderful.
Hello to you and your listeners.
Thank you so much. Yeah, I'm glad to have you here. And Sid, you have a very storied career and a number of things that we could talk about. But why don't you give everybody just a quick couple of minutes about your background and who you are?
So, started my first business out of college. I'm an immigrant from Iran. I came here by myself when I was 16. Exited that company. Then did a lot of work in the 80s with very large companies such as Motorola, Federal Reserve Bank, and so on strategy and operations. Started my own firm in early 90s, actually late 80s, and did a lot of advisory work as well as some what they call a turnaround, basically buying companies, mostly distressed companies in distribution and manufacturing, and so forth, and turning those around. And along that journey in the 90s through 2000, I started a number of companies and exited most of them and had a couple that didn't work. After the last company that I started in the early 2000, which was a carve out, meaning we bought a piece of a company and brought it out. After exiting that, I became essentially a full-time angel investor. I was the president of Tech Coast Angels, which is the largest angel investment entity in U.S. And had a fund that we made a VC fund for very early stage companies. Did that. I still do angel investing. I still work with companies, and we can talk about my criteria and what I look at and why. But in mid, let's say about 2010 or so, I jumped into one of my companies that I was the chairman of as the CEO to drive it to exit. Sold that company to KPMG. I was there for about 5 years, helped them start a fund for $100 million. Then last thing I did was I was the head of the national leader for strategic innovation for the strategy group. During my time at KPMG, I was also involved in a number of large size acquisitions, both on the buy side and the sell side. So I guess I cover all the stuff that your program is about. I have been an entrepreneur. I've built something. I've exited. I've made the investment, and been in through every one of those seats.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Beautiful. Absolutely. Yeah. You're covering all the different seats. Absolutely. All the different sides of this. And, I want to go back to what you said in the very beginning, which was you came here from another country. My guess is you weren't speaking great English at the time, but you started a company when you were 16 years old.
I started the company when in college. I came here when I was 16.
Okay, gotcha. Okay,
so I would say I was maybe 20 when I started it.
Okay, so you've had the entrepreneurial itch since the very beginning. It sounds like.
Yes, I did. One of the things that I'm an author. I write books. I write a lot of articles at different places, from Time to Harvard Business Review, London School of Economics, to Newsweek and Forbes and Fox and all that sort of stuff. So one of the things that I talk about in one of some of my articles and in my book is this notion that we have a different definition over time of entrepreneurship that has been kind of promoted. But entrepreneurship, the word entrepreneur was first used in the 1700s by a French guy who says an entrepreneur is someone who has something and wants to exchange it for something better. The definition of risk was added by an Irishman about 50 years later or so. He said an entrepreneur is somebody who has something. This could be an idea, this could be a product, this could be his or her time, something, and wants to exchange that with something of higher value, knowing that there is risk, that it may not happen. So an entrepreneur, in my opinion, is everyone. We all want to exchange what we have for something better. That is our desire to evolve, to survive, to be better, to do things that are more valuable to us. The question becomes, what are you exchanging, and what are you exchanging it for? Martin Luther King may be considered an entrepreneur because he exchanged what his thoughts and ideas were. Mother Teresa was an entrepreneur, so is Elon Musk. What they exchange their capabilities, ideas, and what they have for is entirely their decision. So I would say every immigrant is an entrepreneur because they are exchanging what they have, hopefully for something better, knowing that there's some risk. The question then becomes, how do you deal with what is inherently within your DNA, within everybody's DNA? That is, there was a study done by Texas A&M that 500,000 years ago we built this gene in humans that drives us to not only survive but to thrive, to look for something better. So it's in all of us. The question is, can we realize it? Then can we utilize it? And can we define our own personal philosophy of what entrepreneurship is, and what we have, and what we would like to change it with, and what level of risk are we able to navigate to get what we desire to get?
So I think you, in a roundabout way, you answered a question I had, which is, certain people would never consider themselves an entrepreneur, let alone entrepreneurial, because the risk is too great, right? But there's other people that would never want to have a job because they feel the risk of having a job is too great because of the opportunity risk of what they could have done, they could have created. So when you're, talking and you're writing these books, you're writing these articles, and you're going on podcasts, what do you see as the differentiator between the person who wants to go start their own company, whether from scratch or however else, versus the person who might still have that gene in them, but on the other hand is like, nope, I will never do that. I want to go and have a job instead.
So that's a loaded question, Jeff. So it needs to be kind of structured or divided up into multiple pieces. The first is fear and addiction to sameness, which is we have a certain level of comfort, and we think that people change because of two reasons. A is trust, and B is severity of the problem or the opportunity. So if I don't see the opportunity, or I don't see the severity of, oh, this is a problem, where I am is a problem. So if somebody is seeing that, hey, they got laid off, they're in bad shape, you see, all of a sudden they want to do some hustling on the side, or the other is, oh, I can do a lot better than this, and then they jump into entrepreneurship. So they change because of one of those reasons, but then they have to have trust in leadership, trust in partners, trust in their ideas, trust in the economy, trust in themselves, most of all. So those two elements define people in one direction or another, and that is fear of losing what I have versus what I can potentially get. The second is the view of risk. So I told you about selling a company to KPMG. They are in the accounting business, in advisory business. They have probably, I don't know, a few hundred people in their risk division only, that they evaluate risk of everything, right? So I was talking to the global head of risk for KPMG as a part of selling the deal. They wanted to talk to me. And the question was, Sid, you're an entrepreneur, you're a risk taker. And we are a company that tries to avoid risk. How do you see that? And what I told them was the following. I said, how many times, I don't recall his name, I said, how many times have you written $1 million check for a business? He said, never. I said, well, yeah, you're playing with the KPMG's money. You're playing with I'm playing with mine.
Right.
And I tell you what, I am a lot less riskier than you. A lot less, except I navigate risk. I'm not you're trying to manage it, control it, put it out. I'm trying to navigate through it because life is full of risk. The question is the probability of what happens to you. A job of an entrepreneur is to minimize the probability of failure, maximize the probability of success. And it is in that spectrum that you can navigate risk. Navigating risk is like, there's a chapter in one of my books, I call it Be a Pilot. Be a pilot. A pilot, you have all these thousands and thousands of pilots that take off and land every day in commercial planes. They have a list. Engine, check. Electrical, check. Fuel, check. Those are risk management things that they're doing. So they have a very contained risk of risks, and they still take off, they still fly, they still land, and that happens every day, every minute of every day. When you come to those are commercial pilots. Those are people who are working everywhere in corporate life. The risk is defined. There's a guideline. Here's the freeway. That's where you run. When you come up with entrepreneurs, particularly in the early stage stuff, you're like a fighter jet pilot, which means not only do you have all those risks, you have other risks. You may run out of fuel. That's cash. People are shooting at you. That's the competitors. So you have additional risks. You're putting the plane together as you're flying. You don't have the landing gear yet because your product is not complete. So there's additional risks that are introduced. And then you have what I call weekend flyers, pilots. Those are people who they have hobbies. They say we're hustlers. They do things on the weekend and whatever. They are kind of entrepreneurs. They have some risk, but they're trying to contain it. So they want to be in the both worlds. One leg here, one leg there, which often, by the way, doesn't work. Because you can't ride a horse halfway. You'll fall. So the reason that I think a lot of people, although they don't realize that they are an entrepreneur, that we all are. A single mom or a single dad who works every day and goes to work and works 16 hours, 18 hours, doing whatever they're doing, cleaning sewers or doing whatever they're doing. Working in a mine, working at somebody's home, cleaning things, whatever they're doing. That you don't look at them as entrepreneurs, but guess what they're doing? They're exchanging their life. 18 hours a day, 16 hours a day. They collect $1 here, $1 there and save it because they want to take their kids to Disneyland. The way Something of higher value for them was the happiness of their kids at Disneyland. They used their entrepreneurial gene capabilities by exchanging what they have, their time, their efforts, what they know how to do, with something better. The question is the definition of the better.
Yeah. You said just a lot there. And there's a couple of things I really want to unpack, which is risk tolerance, right? And fear. And you talk about the pilots. So I was a scuba diver while I was in the Navy, and there's a checklist for everything. I ran a nuclear power plant, checklist for everything, right? And when you follow a checklist, especially if it's a predefined checklist, then a lot less risk. Those are all risk mitigators. We, of course, talk about that when we're investing and evaluating businesses. What are those risk mitigators? What are those risk factors, and how can we mitigate that risk? And then there's the fear thing. And what you said with your example of KPMG really hit home with me, because I've run, divisions and departments in big companies. I've run departments and divisions in the military. I've had a lot of other folks. And I ended up finding that I feel like it's less of a risk for me to run a company of my own than it is to be part of something else, simply because when I'm in charge, I have the confidence that I know what's going to happen. And for me, my ability and my confidence, my experience myself mitigates the risk of me running a company, versus if I work with somebody else that I don't know and I look at their track record or their ability to manage or their ability to lead. Because I don't know that, for me, that's a risk that I'm taking by going to work for somebody else. And so I think it's just the lens that you look through, one, your own confidence, your own fear perspective, your paradigm, right? As well as what those risk mitigators are. And I think a lot of people, if I'm reading between the lines of what you're saying, since they haven't experienced certain things, they have no lens to look through to experience that. So the person who's always had a job their entire life looks at the entrepreneur as crazy and thinks it's just absolutely insane that they would even try that. They might look at the angel investor. That's insane. Why would you ever do that with your money? Because they don't have that same
part I agree with. Why would you do that? The angel investor part, it is crazy. But let me fall back on one thing that you said, because it is one of the things that I have an issue with. We have a culture of looking at how-tos. That is, we're constantly looking at a big how-to. No, there are mechanical things that, you need to learn. How to, do your accounting, debits and credits. There's a certain, how to put a link on a social media with a message that works this better. Yes, those are how-tos. But we're all unique. You're not Elon Musk. You're not Jeff Bezos. I'm not. We're all different. We all come from different backgrounds. We have different capabilities. We have different IQs. The people that work with us are different. Our parents are different. Our financial backing is different. There are no two people that are alike. Okay, so what worked for Elon wouldn't work for me. Now, the mechanical things are okay. I can learn the tools of the tricks of doing business. But what happens is a lot of people are trying to do a how-to that copies somebody else's of how to run a business, and it's very unique to you. So until you find your authentic self, your own philosophy of how you run something, what kind of a leader you are, you could read 1,000 leadership books, but that does not make you authentic you. It's just you're trying to be somebody else. And there's an old saying that's, the more you use a Xerox machine and copy things, the 10th copy is a lot lighter than the original copy.
Yeah.
You're never the same. And success, prosperity, having that edge, winning competitively is about those little details. It's not about, marketing is important. Everybody knows. You have to have a sales team. Everybody knows that. So it's not about generalities that are in the how-to books. Even it's not in, hey, do A and then do B and copy and paste this over here. And those are mechanical things. Mechanical things are important, but that's not entrepreneurship. So whoever tells me that, hey, I'm looking for a how-to, what's the best how-to book for being an entrepreneur? I think you're misleading yourself. So it's
Well,
all
I
in
think
your
that
mindset. The mechanic. Again, I'm not saying how-tos are bad. What I'm
right.
saying is, if you add all the how-tos in the book in the world and you read all of it, you're still not an entrepreneur, business person of any sort, of any kind. You are just a collection. Here's the thing: ChatGPT has read all of entrepreneurship books, but ChatGPT is not an entrepreneur.
That's a great analogy. Well, I have this conversation with people regularly, and the idea is, yeah, you can go read whatever you want inside of a book, but there's this other part of our brain and our body that, yeah, we understand it logically, but until you've gone there, the famous quote about Mike Tyson, everybody has a plan until they get punched in the face.
That's right.
Entrepreneurship's the same way, right? Yeah, I did my business plan, I did my deck, they do all the things, all the how-tos, like you're saying. But then something happens that trips them up that they weren't expecting. And it's the emotional response that they have to deal with. It's the irate partner that they have to deal with. It's the upset shareholder. It's the spouse that's saying, it's taking you too long. Why are you still doing this?
You
right?
have to report to your kid when you don't show up. You have to make exchanges all the time. There's another thing that if you read my recent stuff, that I'm a believer in this idea that really building a successful company is built on 5 pillars. Okay, these 5 pillars are customers, obviously, employees, partners, investors, and the society. We have an exchange with each one of these. So most people think that it's the salespeople that sell. That is not true. It is the customer who buys.
True.
Customer has its own reason to buy. They go through their own filtering of, is this good, this exchange? You're giving me this, I'm going to give you my money, and I make the decision. So the decision to make money is not the companies, it's the customers.
Right.
The same thing happens with employees. You think you had a job offer for somebody, and the guy says, yeah, I'll start Monday morning. The guy who accepted the job looks at this and says, yeah, I'm really worth it $75 an hour. He's giving me $50 an hour. Therefore, I'll give him 3/4 of my time, my attention. You don't know that. He or she accepts that job based on the reasoning in their mind. It may be the options. It may be their greed of making a lot of money. It may be that they don't have payment for their rent that month. It may be that their kid is sick and they need the benefits package. It may be that this is a closed place. It may be because they work from home. It's 1,000 reasons that people have in their mind. They make a decision. It is their reason to come in and at 3 o'clock in the morning give their best to the company, or at 5 o'clock shut down and say, heck with you. So
Yeah.
The same thing with partners. Partners are with you because you pay on time, because you don't squeeze them, because you are a good people, because you have a cause that's common with them. The same thing with investors. They don't invest just to get a 10x return. They invest because they like you, because they're aligned with your thing, because they think they can add value to your thing, because of many reasons, because they invest in a company that does, I don't know, cancer research because their mother died from cancer.
So what you just said, I think, is really, really important that we dive into a little bit. We don't have a lot of time left, but I tell people come to us every single day asking for us to invest, asking for us to introduce them to investors and all of that. And they don't understand that there's a process for raising capital. And it doesn't mean that you just go after the person with the most money. Everybody thinks, well, this person has more money than they have time. They don't need all that money. Why don't they just invest in me? Why can't you just introduce me to this person, Jeff? I said, because it's not about the money most of the time. Every angel investor that I know still has money in a lot of other things besides angel investments, right? And they don't want to put a lot of their percentage of their portfolio. Most of them will do maximum 10%. I don't think I've ever seen anybody do more than that unless they were the founder owner who had an exit and they still invest in the original company. But they don't understand this idea, what you just said, which is their why for investing in a company. And you've been the president of Tech Coast Angels. You're doing angel investing for a long time. So can you walk us through your process for investing and why you do it?
So again, maybe when I was the president of Tech Coast Angels, and then when I was doing the VC thing, in a year I may look at 3,000 deals. That's a lot of deals.
It's a lot. Yep.
Out of that, I may actually somehow connect with about 300 to 400 deals. That's a lot. That's one or two a day.
Still a lot.
Every
Yep.
day of the week, every week. And we may make investments in the fund. We may make investments in 4.
Yeah.
Okay. So the funnel is 99% of the people, 99.9% of the people who look for money never get money.
Yep.
Okay. So but we read this stuff. Oh, Mark Zuckerberg did this, and this guy did this, and that guy, and everyone says, "How come they got so much money and I didn't get so much money? How come my deal, my idea is better than them?" So, the probabilities are against you if you're looking for money. That's for one thing. That you have to accept. The second thing is every investor has a different approach. There are people who are spray and pray, meaning they put in 25, 50, 100, depending on how much money they have, $500,000, $1 million, whatever, on 100 companies, and they hope it would stick. Okay. There are other people that are very more. I mean, there's not that many of them, by the way.
Right.
There's not that many of them. Then there are the people who are followers, meaning that, for example, I make investments and there are 10 or 12 people that whenever I make an investment say, can I come in? Can I put something in? And so they're not necessarily leading a deal, they're following a deal because they want to do what you just said, distribute or have some sort of a diversification of their money in early stage stuff. Then there are professional angels, and if that's what they do for a living, okay, that's what they do for a living. In my case, now a lot more than before, I do not invest unless I am somehow involved, because when I look at all the investments I've made, I made 4.3 times more from the companies that I was very close to.
Right.
Because entrepreneurs think that money is the biggest advantage that they get. If I had the money, I would solve all. Investors think it's not the money, it's the experience, it's having been there, it's making the right decisions at the right time. So I use an analogy. I say, hey, you and I don't know, you've been in LA, but there's Orange County and there's LA, and there's it's always pretty crowded at 4:00 in the afternoon. It's horrible. The traffic is horrible. So it could take you an hour, it could take you 4 hours, right? Along the way, you're burning fuel and you may miss the deadline that you have. What I'm saying is if you have somebody in the car that has driven this road before, he says, let's get off this exit. Let's go around because I can get you more. And you save money, fuel, and you get there faster. Now, you can experiment, but it's foolish. So investors don't pay or don't invest for people to experiment. And this notion of fail fast, fail often is absolutely ridiculous. Although I practiced it for a while myself as an investor, it is foolish. You have to learn fast and learn often. That doesn't mean necessarily I have to do it. If you've done it, I'm going to learn from you and not waste my fuel, not waste my time. So what my philosophy is that I have to be involved. That doesn't mean I'm taking a position in the company. I'm not the CEO, nothing. But I am hands-on. I mean, they consult with me, and I say, hey, here's where we are. So what that means is I got to like the people because I don't want to waste my time with people that I don't like. Life is too short.
Yep.
And I know that 9 out of 10, the company won't work. That may be. So every one of the entrepreneurs are 100% believer in their products, in their strategy, and what they're doing. Now, it may not sound right. I believe in every one of them, but I believe that 9 out of 10 are going to fail.
Right. You're realist, pragmatic.
Okay. So I have to make sure that I am by their side, and I use my experience, and their intelligence together. Now, there's another thing people look for: coachability. You've heard this 1,000 times. Coachable doesn't mean a wimp. Every investor wants the CEO of the company to be a strong person, to be able to negotiate, to be able to be driving teams, to be able to be inspirational, visionary. They don't want a wimp. Coachability doesn't mean being a wimp. Coachability, I worked with one entrepreneur. I met him. He read my book. 2 weeks later, he called me. He says, "Hey, Sid, I want to meet with you." I said, "I'm going to China." He said, "No, no, when are you going?" I said, "Tomorrow." He says, Can we meet today?" So he came in. He had 30 days of notes. Okay. So we sat at the Starbucks, talked for about an hour, and I was going to China for about a month. So we came up about 5 things that he needs to do. Right. I came back after a month, and a few days after I got there, he reached out to me. He said, "Sid, you should have been back by now." I said, "Yes, I'm back." He said, "Can we meet?" I said, "Sure." Now, we came up with those 5 things. I assumed I personally, I have to admit, I could not do those things in 6 months or a year. He had every single one of them done. Okay. But he changed it, he maneuvered it, he fit it into situations, he maneuvered around. But every single one of them, that's execution. That is coachability. That you say, "Hey, here's the thing," and then he or she would fit it within the context of what happens. That's the entrepreneur that sees the environment and captures the timing like a dancer.
Yeah.
Like a dancer. A dancer can be very choreographed, or it could be it could be a free form dancing, depending on the timing of the music. So a coachability means, hey, let's work through the message of the dance. Let's work through what we're trying to do, and then you are the dancer. I'm not the dancer, and you're on the front row. Which means there has to be trust. There has to be trust that you're going to be flexible, that you don't have what I call founderitis, which is like arteritis of the founders, that they say my way or highway. I know how this works. This is the way
Yep.
it is. You and I, neither one of us know how it works. The market knows, because we don't have the decision to buy. They have the decision to buy. Right? So there's another thing that people come up with, this idea of MVP, minimum viable product. Viable to who? So a lot of entrepreneurs make a mistake. They say viable. Well, I had so much money to build this. That's not viable because you had so much money. Viable is what that guy wants. Viable to him is what matters, not viable to you and I. We are nobody. We are a facilitator, a delivery of a value.
Yep.
As opposed, we are not the king. Neither is the customer. Customer is, yeah, they say customer, but no king can deliver everything in the world. You have to have everybody involved to get to prosperity of a nation.
It's such an important point, right? One, coachability. You want the leader to be strong, you're right, but they need to take direction. They need to take feedback. I mean, just taking in all the different signals from the market alone needs to be able to, you need to be able to shift and do whatever you need to address that concern. Because if people aren't going to buy your product, you don't have a business. And that's one of our very first litmus tests, is how many people are using what you've created. And I know there's a lot of people out there that'll say, well, angels are meant to get people off the ground. And I say no, right? It's not about your resources. It's about how resourceful you are. Like you said, the guy that you gave 5 things they needed to work on and they got them done in a month. That's incredible. That's what you want to see.
Now, that company, by the way, is $600 million now, and they just got $110 million from SoftBank.
Yeah. So they know what they're doing. They got a great leadership behind them, great advisory team, and took action. Like, implementation is so important. And I can't tell you how many times I've had people come to, whether it's our events or our webinars or emailing us because they've been on our list for a long time, and they'll reply to an email from time to time and say, when are you going to invest in me so I can get this thing off the ground? And the answer is that person will never raise capital. They will probably never be successful.
Yeah.
Because they don't know how to be resourceful.
There is one thing, Jeff, that has to be said. I don't know how much time we have. Let me spend a couple of minutes on this gap that has been created. So, and this is pure math. This is pure, it's very structural. In the past, if you go to the 2000s when I was doing it 20 years ago, uh, there was family and friends. There were the angels. The angels were closer to the friends and family. And then immediately there were the VCs that they would put in a few $1,000,000 and then they go away. So what has happened is the VCs have gotten, first of all, about 50 some percent of the VCs failed. They went away. Some of the big ones had negative returns, big ones. So what happened was they went upstream. So they said, my chance of success as a VC is if I put in 5 million and if I keep another 2x or so, another 10 million on the side to back up my deal, then I have a more mature company, I have a more mature product, and so my risk is lower. Okay? And the thing is that if I have a bigger fund, if I'm a VC and I want to increase my management fee, I have to have a bigger fund. If I have $100 million fund, I make 2.5% of $100 million. If I have $1 billion fund, I make 2.5% of $1 billion fund. I have a better life. And as a partner, I have to be on the board of these things. I can't be if I put in $1 million in each company at $100 million fund. I have to be in 100 boards. It's just not possible. It's not feasible. So they moved up.
Yep.
So the gap between the angels and the VCs started opening up. And angels are not in the business to backing up their money and backing up their money and backing up. It's their own money. They don't, VCs, it's somebody else's money. Okay? A lot of people make the mistake of saying, oh, this guy is a VC. They think it's his money. It's not his money. He raised it from somebody else, and he's the administrator, the distributor of this money.
Yep.
Okay? So the gap opened up. So what has happened is now the angels have moved up because they can't sustain forever. So the closer they are to the next level, their risk is lower. So now they want more progress. They want more activities. They want more customers. They want proven stuff. So they've moved up. Yes. Is this good for entrepreneurs that are earlier? No, it's not. But I think it actually is. From their perspective, it's not because they don't have the money. From a perspective of creating something of value, they have the best companies in the world. Microsoft, IBM, you name it. They have been built through recessions because they've been forced. They have been forced to focus on value and not be dazzled with, oh, let's go get this. No, we need a number of dollars to spend on marketing. They're focused on one thing, the reason that people buy. And if you satisfy that reason, you have a business. And if you crack that nut, you will have money flowing your way, without a doubt.
I love that. It's so true too. And Sid, we could talk about this all day. Maybe we'll have to have you back on another show or have you come speak at one of our events. But it's incredibly important for people to understand that your resourcefulness is what's going to get you over that finish line. It's not just having access to an enormous network of capital. And as an investor, like you were saying, we're looking for how resourceful that individual is, how coachable they are. Of course, they've got to have a good product and all of that stuff. But I love the idea and the thought process.
So one last thing, Jeff, before we part, this I tell all entrepreneurs, and I talk to a lot of entrepreneurs that come to me. I say, the best advice I can give you is don't take anybody's money. Because they're going to be intrusive. They're going to be, you can buy the best advice in the world. You can have, if you listen, there's lots of stuff that you can do. But if you can avoid taking money, avoid taking money. Entrepreneurship is not, an investor is not there to give you a salary. That's a job. Go get a job. If you're saying, well, I can't do this, I don't have a salary, then you need a job. You don't need this. And a lot of entrepreneurs feel that, if I want to start this, I have to find an investor to pay my salary. If the investor wanted to do that business, they already had the money, they could go do it and hire anybody they want. So are you willing to give 95% of your business to them? Yeah, then you're their employee. They're paying for your...
Yeah.
But that gap is hard to fill mentally.
It is. It really is. No doubt about it. Sid, this has been an incredible conversation. How can people find out more about you, get your books and everything?
If they search me, Sid Mohasseb, they'll see everything that there is. Lots of articles, my TED Talks. They can see my books. One is called The Caterpillar's Edge. The other one is You Are Not Them, The Authentic Entrepreneur's Way. That's really focused on some of the stuff, being a pilot and being authentic. And I kind of drill down on the fear and some of the stuff that we talked about. I drill down on that in that book, the You Are Not Them book. The both on Amazon, and they can find it under my name. And my email is sid@mohasseb.com. It's pretty simple. And my journey is at mohasseb.com, which is my site. They can find me if they want to.
Easy. And we'll put all those links in the show notes. So, Sid, thanks so much for being here today. I really appreciate it.
It was a pleasure to be here.
Absolutely. Wonderful. So, for those of you out there watching, listening to this, make sure you like, subscribe, and share. And we'll see you on the next episode of Angels, Exits, and Acquisitions. Thank you.